Hello, my friends. Today is March 2nd, and this is Markets Weekly. So this week, another great week in markets. We got the S&P 500, the Nasdaq closing at all new all-time highs. It looks like the crash up is continuing. Now, I've been hearing more and more anecdotal reports of people who are not usually involved in markets becoming interested and becoming invested. Now, when I hear stories like this, I'm of two minds. On the one hand, perhaps it marks a top. After all, we've heard these stories, say, during the housing boom in the early 2000s, where waitresses had 5 houses, gardeners had 10 houses, and that seemed to mark the top. Or during the tech bubble in the 1990s, we had everyone and their dog buying all sorts of tech stocks, and that seemed to mark the top as well. Now, I look at this differently. I think to have any proper bull market, you need to have a lot of involvement. So hearing widespread involvement in the market gives me additional confidence that we are in a bull market. Now, these things, they can go on for months, they can go on for years. I don't actually think it really tells you that much as to how long this can last. Now, everyone has a different view of this. I present mine. I encourage you to listen to other people to get their perspective as well. But I personally think that we are going to surge. But that's not what we're going to talk about today. Today, we're going to talk about three things. First, let's talk about Bitcoin. Bitcoin has been in the press nonstop because it has basically soared in price. Let's talk about what could be driving that. Secondly, let's talk about Japan. So we got some interesting data from Japan. It seems like their inflation is hotter than expected. And it seems like finally, the Bank of Japan might be ready to hike rates a bit and maybe exit negative interest rate policy. And lastly, I want to talk a little bit about a lot of the news that we've heard on the Western powers seizing Russian foreign reserves. So my sense is that they've been building a case for that over the past few weeks and that they're going to do it. Let's talk about what's happening there and how, again, that strongly suggests that the monetary order, the financial system, is definitely heading towards more of a multilateral system, not immediately, but gradually, and in my view, inevitably. Okay, starting with Bitcoin. So, as we can see, Bitcoin has been surging. It's not yet at all-time highs, but it looks like it's inevitable. Now, the way that I look at Bitcoin, same way I look at any asset price, always about supply and demand. So let's break it down. So I think that the proximate cause of the surge in demand for Bitcoin really is the Bitcoin ETFs. They are making Bitcoin a lot more accessible to the public. Now, looking at Bitcoin, it's an interesting asset, but if you want to buy it, usually it's not that straightforward. You can go and, of course, get an account at a cryptocurrency exchange, but then I think that's kind of difficult for most people who are just not that attuned to markets and to technology. What's this thing about having a wallet and so forth? Now, the Bitcoin ETFs really solve that problem by making it so easy to gain Bitcoin exposure that even a boomer can do it. Just log into your Schwab account or whatever and click buy, and you can get Bitcoin exposure through an ETF. Now, if you look at a graph of Bitcoin ETFs, you can see that they've had tremendous amounts of inflows by several billion. So that's obviously going to be having an impact on Bitcoin prices. Now that we have these big pipes where money can flow through ETFs to Bitcoin, that's a huge tailwind. Now, one other thing that I noticed that I think is super interesting and super important is that Bitcoin seems to have more widespread appeal or mainstream appeal even among the institutional asset community. Now, Fidelity Canada has an ETF, they call it a quote unquote conservative ETF or something of that sort. They've changed their model allocations to have 1% to cryptocurrencies. Now, I'm pretty sure what's happening is that all these, their clients are reading all this excitement about Bitcoin in the news and wanting to get some exposure, and so the advisors are obliging. But the thing is, Fidelity, it's a legit mainstream organization, and the ETF is considered to be conservative. And so if you have more and more asset managers, more and more institutional investors just allocating a little bit, a trace amount of their AUM to cryptocurrencies, for them it's a small amount, but for the Bitcoin, for the cryptocurrency community, it's, hundreds of billions of dollars. And so that could really make assets like Bitcoin and other cryptocurrencies surge. So there's a lot of potential there for some really, really crazy upside in these cryptocurrencies if this continues. Now, this movement by this Fidelity Canada ETF, it's just one fund, it's just one branch of Fidelity, but it could suggest that it's becoming more popular. And, once one person starts, maybe others will follow. So we'll see. Now, the other side, of course, is supply. So in April, we're going to have what's known as a Bitcoin halving. So the halving is, so as we all know, Bitcoin total amount is 21 million, never going to be more than that, fixed supply. But the rate at which miners can produce Bitcoin, that varies over time. A halving is when the rate that miners can produce Bitcoin declines. And so you can say that, in a sense, perhaps you can think of the supply of Bitcoin as becoming a bit scarce, at least from a flow perspective. Now, historically, these halvings have been events where people perceive it to be bullish for prices and start buying Bitcoin and pumping the prices up. Now, seems like it's doing this right now. Now, just to take the other side, though, there is another interesting note from JP Morgan, who suggests that halvings are actually might not be very good for Bitcoin prices, simply because it raises the cost of miners. Now, again, I don't really study this all that much, but I just thought it would be helpful for you to know that there are two sides to this, just so you can make a better decision. So, the next thing I want to talk about is what's happening in Japan. So Japan, as we all know, even though the Fed, ECB, Bank of England, Canada, everyone else in the world has been hiking rates to fight higher than expected inflation, the Bank of Japan has actually done nothing and sat at negative interest rates all throughout the post-COVID years. But it seems like that might finally be changing. Now, even though the Bank of Japan has an inflation target 2% like everyone else, and even though inflation has been far above the Bank of Japan's target for some time, the Bank of Japan hasn't felt like doing anything. Now, they were suffering years of disinflation and sometimes deflation, and they didn't want to, raise rates when finally they seemed to be at potentially defeating disinflation. So they didn't want to, ruin the moment. They wanted to be sure that inflation was sustainably around their target before they would do anything. And now they seem to be finally more comfortable. Now, recently we had their CPI come in hotter than expected, but no, not especially hot, still at 2%. But there's more and more signals from members of the Monetary Policy Committee there that, maybe we can start to move monetary policy a little bit. Now, the deputy governor of the Bank of Japan gave a really interesting speech, I believe a few weeks ago, where he noted that, even if we were to hike rates, we are only becoming less accommodative. We're not becoming restrictive. So what he's saying is that moving from negative interest rates to say zero, it's not tightening policy so much as it is about becoming less accommodative. The policy will still be very accommodative. Now, people have been speculating on the Bank of Japan raising interest rates for some time, but it just hasn't come. Now, the best way to look at this is to look at the 2-year JGBs. Again, 2-year bonds are very sensitive to the path of policy in Japan as they are in the US. And you can see that the 2-year yield in Japan has been soaring over the past few months. Markets are very much prepared for Japan to exit negative interest rates. Now, what does that mean for markets broadly? So, first thing you want to look at is, of course, the currency. So, as everyone in the world has been raising rates and Japan is still negative, that's been tremendously negative for the Japanese yen, and we see the yen around 150 yen to $1. Now, some people worry that once Japan begins to raise interest rates, well, maybe the yen appreciates significantly, maybe it blows up a whole lot of carry trades. carry trade would be when you borrow, say, in a cheap currency like the Japanese yen and use the proceeds to buy higher yielding stuff in other countries, in Eurozone, in US, for example. Now, that's been a constant fear for people for some time, but I don't really worry about that because, as we just discussed, the Bank of Japan is well aware of the amount of levered positions here, and they want to go very slowly and have been telegraphing their move months in advance. So even though we see the Bank of Japan probably going to raise rates soon, you can still see the yen around 150, and everything else in the markets seems quite steady. At the end of the day, even if the Bank of Japan raises rates a little bit, the interest rate differential between them and the US is still large. And of course, the market has been pricing in fewer Fed cuts. So I think this is going to be a big moment for Japan to finally exit negative interest rates. But I think that this has been honestly telegraphed to the markets just for such a long time that I don't think anyone is going to care. Okay, the last thing that I want to talk about is this development we're seeing where the Western powers are going to do something about Russian foreign reserves. Now, just to rewind a little bit, now, a couple of years ago, Russia invaded Ukraine, and what the Western powers did was they immediately froze Russia's central bank reserves. Basically, the Russian central bank, they have dollars and euros on deposit in financial institutions in the Western world. And when hostilities broke out, the Western powers froze access to them. So basically, Russia wasn't able to access them anymore, and it created a lot of problems for them. Over the past few weeks, I'm getting the sense that the Western governments are trying to manufacture consent to actually do something about those reserves so they're just not frozen. So the way that I look at this personally is that there's a strong relationship between the media outlets and the government, so that when the government wants to do something, they will tell their media outlets to run stories that prepare the public for it and to build support for it. And we see that in the Financial Times, in the Wall Street Journal, and so forth. All these opinion pieces trying to tell you that it's actually a great thing for the Western governments to take money, take the reserves, and give them to Ukraine. Now, the backdrop of this, of course, is that the war is not going well for Ukraine, and they seem to be running out of funds and manpower. Now, in the US, Congress has been deliberating on a bill to send additional funding to Ukraine, but it looks like it's not going to happen. And the European governments, they don't have that much money either. So they're looking around and they're trying to find ways to get money to Ukraine. So they came up with the idea, well, we have these reserves that used to belong to Russia. Why don't we just give them to Ukraine? And that's the initial idea floated by the US a few weeks ago. Just take the 300 billion in Russian reserves and just give it to Ukraine. But, aside from being, most definitely illegal, now to be clear, governments make laws. For them, the law is really not an obstacle. But their self-interest is. So when if you do something like this, there's going to be some retaliation. So that's one thing to keep in mind. But the European powers didn't seem to want to go for that, so they're proposing a little bit of a half measure. So instead of taking the full 300 billion and just giving it to Ukraine, why don't we just take the interest income from that 300 billion and give it to Ukraine as well? After all, interest rates have risen a lot, say 3-4%. If you on $300 billion, that's several billion a year. Why don't we just give the interest income to Ukraine? Won't feel as bad as taking everything from the Russian central bank, but we'll take some and we'll give it to Ukraine. Maybe that's legally defensible. So maybe that's what will happen. Now, at the end of the day, though, like I mentioned before, government makes laws, makes rules, so there's really no such thing as illegal to them. But on an international level, you have to have people to buy into your laws from other countries in order for the system to work. And so if you're doing something like this, I think it's a really big blow to confidence in the global financial system as designed from the Western powers. So if you're someone like Saudi Arabia, if you're someone like China, if you're someone like India, who, probably friends with the rest, but sometimes have divergent interests, you're going to be really worried about this. You're going to be worried that, one day they're going to try to force you to take positions you don't want simply because if you don't, maybe they'll take your money away from you. So this definitely speeds the path towards moving towards a multilateral system where we have something that is in addition to the dollar system. Now, everyone in the West thinks that, we can do whatever we want because after all, you have no alternative, which is totally true. There's no alternative to the dollar. But when you do things like this, you are creating the need to have alternatives, and eventually they will arise. So I think this is tremendously bearish for the Western financial system. But again, this is not something that's actionable. This is something that's going to take time. And one last thing I would leave to you is that why is it so important to get all this money to Ukraine? Well, one of our leaders in the Defense Department, Victoria Nuland, will tell you why.
By the way, we have to remember that the bulk of this money is going right back into the U.S. economy to make those weapons.
Again, when they take money from, let's say, the Russian reserves and give it to Ukraine, it's not actually giving it to Ukraine. It's actually giving it to U.S. defense companies who will then give weapons to Ukraine. Anyway, that's all I prepared for today. Thanks so much for tuning in. If you're interested in hearing my latest thoughts, this week I will write about what Governor Waller's proposal for the future of the SOMA portfolio could mean for interest rates. Write about that every Monday on fedguy.com. And if you're interested in learning more about markets, check out my courses at centralbanking101.com. Thanks so much, and I'll talk to you guys next week.